Welcome to How to Invest, everyone. Today we are talking about how to find the perfect stock. I know that everyone out there wants to make money in investing, and I want you guys to make money in investing as well, which is why we're going to be talking about attributes to look out for when you are buying stocks so that you can own really great companies that are going to just compound year after year and help you get to financial freedom or whatever goal that you have. So I'm here with my sister Abby. You want to say hi?
Hi, my name is Abby. This is Investing for Beginners. Hi, my name is Abby. This is Investing for Beginners, Part 5.
Yeah, so if you guys want to learn more about the stock market, this is a whole series, 7-part series. We talked about preparing to invest, things you need to know before investing, how to build a story, stock categories, stuff to avoid was the last video. And now we are talking about great company attributes, stuff to look out for. That can just be a signal that this is a really good opportunity. And if a company has a lot of these attributes, then you can be even more confident that it's a really good time to buy the stock and it's a really good company to own. So just so you know, the reason my sister is here is because she is learning how to invest right now. And I thought if I'm going to be teaching her how to invest and I want to teach you guys how to invest, it would just be way more personable if we can actually, have a dialogue. And if she has questions, she can ask the questions, make sure I'm explaining stuff well. Plus, yeah, it's just comes across differently when I'm literally teaching my sister how to invest. You know that what I'm saying, I actually believe, even though I can be wrong about stuff. So it's a little bit of background. Disclaimer, a little bit of background on myself. I learned investing from Peter Lynch, as I've mentioned in many videos now. He is my investing hero, one of the best investors of the last several hundred years. And he wrote some incredible books that teach everyday people how to invest. After learning from him, I have had really good returns, double the annualized returns of Peter Lynch, because I'm dealing with much less money than him, which I think makes it quite a bit easier. And then, the last 2 years, we'll pop it up on the screen. I've had over 100% annualized returns. So I'm going to teach you the attributes I look out for, the attributes Peter Lynch taught me to look out for, so that you can outperform even professional investors, which I think anyone can. Do you think everyday people can beat professional investors, Ab?
From what you've taught me, yeah, I definitely do.
Yeah, and Peter Lynch agrees, and he was a professional investor that beat all the professional investors. So yeah. Definitely, if you want to learn how to become a really good investor, you should watch these other videos. So, what is something that you think that we should look out for when buying a stock? And then I'll go into the first attribute.
They're innovating in a market.
Yeah, that's definitely really good. If a company is innovating, and it's not just an idea, so it's not just someone's like, "Hey, this company is going to solve world hunger, and they have this great innovation." It's not.
I don't know. That sounds pretty good.
Those whisper stocks, oftentimes, they're not good. If a company is innovating and their product has already found product market fit, they're finding success, and they're actually growing in a market that's maybe stagnant or maybe really old, then that can be a really great attribute. So you see, okay, they're innovating and they've proven that it's actually good innovation. They've proven people actually want it. Then if a company maybe has several successful products, you can trust future innovation more. They have a track record, very different from a company with no revenue yet, who's doing something crazy.
Like a startup or something.
Yeah, it's like, this is going to replace all workers. Someone probably might be able to do that eventually with humanoid robots and stuff. But buying a startup that's innovating is good if they have some of these other signs as well. Okay, so I'm going to steal this first sign that I want to share from Peter Lynch directly. A great company attribute is a company that no one is talking about. It's a company that at least the majority of people maybe don't like or don't think is a good idea. Maybe you have people on CNBC saying that you should sell it. That sort of thing can honestly be a good kind of contrarian sign that it's maybe a good time to be looking at this company. At the very least, start forming a story. because you know that when everyone dislikes something, when everyone hates it, it's going to be at the best multiples, the best price that you're probably going to find for it. And when everyone's talking negatively about a stock, if the fundamentals are still good and the company still has growth ahead,
it's not going bankrupt or something.
It's not going to go bankrupt. We'll talk about that as another one of the attributes. A company that doesn't have debt or has way more assets than debt, because then you can't go bankrupt. But if the sentiment is really bad, that might be one of the best prices you're ever going to find for the stock. So Peter Lynch talks about how he likes stocks that have bad names, like Manny, Mo, and Jack. He said it sounds like the Three Stooges. He said, it's like, who wants to buy this? It's like, if you buy this stock and you lose money on it, you're getting fired for sure. Whereas if you buy IBM and you're a professional investment manager and you lose money on it, it's like, he's like, no one gets fired for losing money with IBM. That's why we've all lost money with IBM. So if a stock it has a weird name, it's like, you literally have an advantage as a retail investor, because the professional investors don't want to buy it. They don't want to look stupid in front of their advisor. No, like literally, it's a real thing. So yeah, a company that with a silly name, a company that does something that's not pretty, it's another attribute of what could be a potentially really great investment. I'll talk about this company in a little bit. It's still very small and very speculative, just so you know. So I don't know for certain that it's a good investment. But I found this company recently called BioStem, BSEM. I actually don't even own it yet, but I'm thinking about buying it. And what they do is they make bandages for foot ulcers using placenta tissue, which is hospital waste from births. So it's like disgust. If it makes people squirm a little bit, my company sits in the waiting room and just sits there like creepers and collects the placenta tissue after, and then puts it on people's feet for foot ulcers of like wounds that won't heal. It's like, that's not sexy. It's like, how do you make, you're at a cocktail party and so it's like, how do you make your money? It's like, I prefer not to say. That sort of company, Peter Lynch says, can be really, really good, because oftentimes people hear about it, they're like, I don't want to do anything in funeral homes. I don't want to do something depressing that makes me think about the fact that I'm going to die soon. I want something sexy. I want something that my bosses are going to be like, oh, that's a really cool idea if I lost money on it. Something that I feel good owning.
But it's good to buy those kind of stocks because they're important, they're needed, they have value, especially in the medical field, where people aren't going to squirm. They're going to say, wow, this is amazing. Yeah, so like an example of a really good investment that Peter Lynch made, and maybe I'll share one that I'm making currently. Because Tesla, I made a ton of money on Tesla, but that's a little bit more of a sexier play. It's not. But it was hated then. It was a company that only lost money on every product they sold. No one wanted to own it when I bought it. So it had the attributes of a good stock back when it was undervalued. But one example, Peter Lynch, he bought a funeral home company that started selling, like you could pre-purchase your casket in your whole funeral home procession. So people would buy it, but they wouldn't actually need it for 20, 30, 40 years. And this allowed this company to just make sales and then just invest this cash. And they could just get so much cash, and the product that they were selling was a promise. And this company just started opening up everywhere. It started making so much money, and no one was looking at it. And analysts didn't want to cover it because it was funerals, it wasn't sexy, the industry wasn't growing, that sort of thing. I forgot even to say in the last video, something to avoid, a stock to avoid, is a company in a super fast growing industry. Because all the new graduates wants to go into that industry. Every startup entrepreneur wants to start something in that industry. So even if the industry is growing 50%, if you have 100 companies that are all competing to take some of that market, the companies themselves, a ton of them are going to go out of business. You don't know who the winners are going to be. Whereas something old like funeral homes,
It's
People
like
are going to continue dying.
people are going to keep dying, and it's not a sexy industry, and you don't have any MIT or Harvard graduates that are super excited to start a funeral home company. So that means there's less competition. There aren't a ton of innovations. So you can make one innovation and it can make you a lot of money for a long time.
Mm-hmm.
Whereas in a super fast growing industry, like a company that's making AI algorithms right now, for example, it's like they might make a big innovation, but there's so many innovations happening in the industry all the time that it might only give them an advantage for 2 weeks.
Yeah.
And then someone else makes an innovation, whereas you make an innovation in funeral homes, then it might be the only innovation for decades. So that increase in profitability might allow you as a shareholder to just make a ton of money for so long because it's not sexy. And if something works, it's going to keep working because there's not new competition.
Yeah.
So yeah, a great attribute to look at is something that's not sexy because you're not going to have that competition. So that kind of ties into an investment I've been making recently. I hate insurance. I look forward to the point where I have enough money where I never have to buy insurance again because I know I've run the numbers. I understand if I just invest this money every single month that I'm paying to insurance over 5 or 10 years, it's going to be way more than I'll ever have in a disaster. So I have a little bit of risk for a couple of years, but then long term, insurance sells you a promise for something they know is going to cost you less than you're paying them. Like, which is why insurance companies have loss ratios of like 60%, and 40% of what you're paying them is just all profit, or they use 20% for running the company and all of that. So I've been buying an insurance company recently. Not sexy, but AI is going to revolutionize it. So the industry itself is boring, slow growing. It's been around for hundreds of years. No one likes it. I don't like it. But companies are hundreds of years old. There hasn't been any innovation in the industry forever. And AI is going to revolutionize it, but everyone is excited about AI is making AI startups that are making algorithms or trying to, do the cool, exciting stuff. There's some companies, but there's not as many companies that are like, oh, AI is super cool. I'm going to start an insurance company.
I'm going to implement it into something old. Yeah.
Whereas, what is AI going to create value for? It's going to create value in all these industries that have huge total addressable markets and already have products. Like, you don't have to create a whole new product. You just have to be able to sell the current product a little bit more efficiently, and you can make a ton of money.
Yeah.
And yeah, the fact that there's hundreds of years old companies in that industry just prove how little innovation is in it, how long you can survive because there's not all this competition all the time.
Yeah.
So that's, one of the attributes to look out for. Okay, so we'll just speed run a couple more of these and then we'll end out this video. If you guys want a full in-depth course on all these attributes and stuff, we are working on a course, which is, I'm sure, going to be incredible, and I highly recommend it. But it's not done yet, but it'll be linked in the description when it is. But just speed running a couple more of these things. Companies with low valuations, or if it's a growth company. So we talked about this a little bit in past videos. But if it has like a low price to earnings ratio, so you're not paying that many years of earnings to buy it, that's a really good attribute. And if it's growing fast, it's going to be more expensive. But Peter Lynch says if you can find a company that's trading that's growing twice as fast as the PE ratio, it is extremely undervalued as a rule of thumb. So for example, maybe a company is growing 50% a year and it's only trading at a 25 PE, that's super undervalued. Even though a company that's not growing at all, that might be super overvalued. And you might want to only pay like a 10 PE for it, a company that's not growing. So relatively cheap. And then it would say a company that's trading twice as high of a PE as it's growing is expensive for a growth company. So if a company is growing 25% a year and is trading on a 50 PE, then it's expensive, according to Peter Lynch. So just kind of things to keep in mind. From one of the greatest investors ever. Another great attribute, which we've mentioned a little bit, but I just want to make sure you understand it's the actual one, is just no debt or low debt, having like a really great balance sheet. So good fundamentals. One thing I love, a great attribute I love, is a CEO who's a founder. If it's still founder led,
Obviously, the founder, better than anyone, understands the vision, knows what they started the company for, can continue driving it forward. They understand all the aspects of it because they were there from the very beginning. Whereas like sometimes you have a new CEO come in and they're having to learn the company. They don't know how it works, so how are they going to make the best decisions for it? And yeah, if you look at companies over $10 billion that are run by their CEO, the annualized returns of these companies are far greater than companies that just have, just these random college educated people come in. They can still do good. Apple's done really, really well after Steve Jobs died because the innovation was already there and Apple didn't really have to innovate much anymore. It just was able to monetize what was already made. So yeah, that's another aspect that I really like. Is all that clear?
Yeah, all that's very cool.
Yeah. Any questions or final thoughts?
No, I don't think so.
Yeah. All right. Also, when you're doing research, if you're ever listening to CEO interviews and stuff, this is my last thought on this. And I learned this from Peter Lynch, and I've had success with it so far. If you hear a CEO talking positively about a competitor company, that's a really good attribute. That's a good sign to look into that competitor company. If their competition really respects them or fears them, then it's probably a company that you might want to own. It's a good green check mark there. Insider buying, if insiders are buying a lot, it's another green check mark. But I could go on and on. There's a lot of good signs of a company. So hopefully this was educational to all of you. Make sure that you drop a big thumbs up if it was helpful, and you subscribe to the channel if you're not subscribed yet. In the next video, we're going to be talking about designing a portfolio. So it's more than just finding a good company. How do you mix companies together to actually make a portfolio that's going to do really well? That's what we're talking about next. So you can click on that video now, and we'll see you next time.
Bye.